Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. And don't we have a whole lot of stuff to go through today? A lot of volatility in the stock markets, volatility in the commodity markets. And of course, any stock codes you'd like me to have a look at, get them ready. We'll go through those in the second half of the show. Now, as always, everything today, general commentary only, doesn't take your personal situation into account. Having been through all that, let's get into this week's first chart. And starting off with the ASX 200. 3 weeks, we've had 3 weeks of persistent selling. Is that selling nearing an end, or is it likely to get worse? I'll come back to that in just a moment. And then over in the US, the S&P 500 and the Nasdaq both just produced some intriguing price action. And probably the most intriguing price action this month. I'll show you what I mean by that in a moment and tell you what implications that could have going forward. But before we do that, let's start with this latest price action in the ASX 200. It's now been 3 weeks of persistent selling for the local market. So from that all-time high back in late February, prices have been down as much as 9.5%. So that makes this one of the quickest reversals ever. In last Friday's strategy session, we discussed the likelihood of a test of the November low this week, and that's actually occurred just in overnight trading on Thursday. And prices have rebounded off that low so far, but look, they still remain under pressure. I'm just going to quickly tidy up this chart a little. I'm going to remove this technical region which we've got on this chart at around 8,600, and that's been a useful level to watch over the last few months. There's been technical activity around there. But I think just with where prices are now, I think it's become a little bit distracting because I don't think it's a near-term support resistance to keep an eye on. So if something's not helping, it's just best to take it off the chart and not clutter things. So I know this is a particularly difficult time for probably most people involved in the local market. These 3 to 5% pullbacks that we often see on the way up in a bullish market, we often experience them, and they're reasonably straightforward to manage. Prices pull back to the moving averages, maybe over several weeks or even over a couple of months, and then they regain their upward momentum. The pullbacks they're relatively slow moving, and they don't cause too much emotional strain if you've got a half decent plan that you're following. Sharp moves like we're having now, well, they're a bit different. The selling typically intensifies as the decline progresses, and some of the biggest losses, as we saw back in April, some of the biggest losses occur near the low. And the reason for that is that people decide they just can't take any more of the emotional pain of losses, and they hit the sell button, and prices just they come apart near the end often. Now, there's actually a name for this, and it's called a capitulation low. So could we be near a capitulation low now? Well, one thing to observe is that the fast move from above the moving averages to below. So this happens, the reason you get these fast moves from above moving averages below, it happens when there's a rapid adjustment in investor thinking, and that's often due to some sort of surprise or shock to the market. And the thing with these rapid adjustments is that they often go too far and then snap back in the opposite direction. So there's a few examples just on this chart, just in this time frame we have here. So let's zero in on this one first. So I'm looking at this one here from early 2022. Prices were above the moving averages and then quickly sold off. So what do you think? What was the big deal back in January 2022? Well, chances are you don't remember, and that's because these things, they seem like a big deal at the time, but when the market ultimately recovers and moves on, we quickly forget how scary it felt at the time when prices quickly went from above moving averages to below. So, what was a big deal in January 2022? Well, it was inflation, it was rising interest rates, it was the war with Russia and Ukraine, and recession fears. So it sounds like a familiar script, doesn't it? So stocks sold off rapidly as investors quickly adjusted for the worst. But then, after a scary 12% decline, so from top to bottom in just a few weeks, that's a 12% decline, prices snapped back towards the moving averages. It didn't lead to a new bull market, as we know. Prices, they rose for a bit, but then they went into a larger decline. And but that's not the point. The point is that rapid adjustments often lead to overcorrection and rebounds. And then we can assess the rebound to help identify what could come next. And in this case, the rally was sold back below the moving averages, a shallow rebound to beneath the moving averages, and more selling. That's another matter. But it's the snapback, which is interesting after these sharp declines. There's another example over here. You can find them all through the charts. Another example here from 2023, above to quickly below. Then there's a snapback. Then here's an example over here in 24, from above to below, then the snapback. Then, of course, we have the example from just last year, from above to below, and then the snapback. So that's that price action that I think it's really worth being aware of and being able to consider as a possibility where we are now. So yes, what we're experiencing now, yes, it could be an exception, and prices might just keep falling week after week for several more weeks without a bounce. It could happen. It's happened before, but those cases are rare. The only occasions I can think of where we've just had this consistent, persistent, ongoing decline without a bounce, it was during the COVID decline, and it was during the crash of 1987. More often than not, it's like what we've just been through. So I don't think this is the time to move towards maximum pessimism. I think it's a time to continue following a good plan and act systematically, not emotionally. That doesn't mean there won't be losses, but I think sticking to your rules and maintaining discipline is how I believe you maintain some control. We can't control the market, but we control ourselves. It's how we maintain some control and ultimately come out the other side when this invariably does finish. If we step back and look at this chart with a bit more time to it, so we'll go back to the COVID lows. When you step back and look at this chart in its entirety, it looks to me like a big rally and an ongoing consolidation. This currently doesn't strike me as a bearish structure. Now that, of course, could change in the weeks ahead, but at this point, like, you look at the overall advance, and it's a rally and a consolidation. We don't have that big bearish turn at this point. That's just the price action we currently have. One possibility I suggested last week is a big range. Maybe prices form a big range in the maybe they're partway through forming that range, and there's more to come. Maybe there's a rebound. There's more back and forth chop, which could go on for months. That remains a possibility. There are all sorts of ways this could play out, and they are not all negative. I think that what's important now is the next rebound. Is it like, and of course we don't know where a rebound could come from. Maybe it comes from lower levels, but let's just say it were to occur from where we are now. What's important next, I think, what does it look like? Is it a shallow rebound? that just chops gradually higher. It doesn't attract much buying, comes in beneath the declining moving averages, and then that provides that setup for then follow through selling to come down, form new lows. So is it a shallow rebound, or is it more that V style rebound where prices quickly get back to above the moving averages and really disengages the bearishness? That's what I'm watching for now. Do we get a structural shift from bullish to bearish, or does the bearish possibility get disengaged by a strong rally? It's the next piece that we need to be watching for. And I think as it stands, this is still classed as volatility. It's a volatile sell-off from above moving averages to below. It's not necessarily the start of a long-lasting bear market. Quickly coming over to the equal weight, the ASX 200 on an equal weight basis. This remains the weakest link in respect to the ASX 200. The equal weight, it's making new lows below what are now declining moving averages. It's also broken below this support at around 2,000, and that support takes in some previous cluster of a high from back in late 21, and then a cluster of highs from around 2024. So it's broken below that support with the latest price action. So this is a weak structure. There's no getting around that, and so it's certainly no time for complacency. And it does highlight the need for being proactive in protecting capital and not just assuming everything will work out. So I'm saying don't automatically assume the worst, but don't automatically assume everything is going to work out either. It's like that sliding scale. We go from bullishness to bearishness, and we're on that sliding scale at the moment, and we're watching how the price action develops. And I think it's about being proactively protective of capital as stocks come back to predetermined exit points. And this is especially so in the mid to smaller cap stocks. This is where, and I'll cover those in a few minutes, of small ords and emerging companies, because this is where some of the heavier selling has been. Again, I don't think this is a case of sell everything, but I don't want to keep holding stocks that are selling off without a planned exit level. Just on that point, I've been selling stocks that have hit their exit levels this week, and as I was the week prior and the week prior to that, and I'll continue doing so. But again, my selling is planned; it's not emotional. I think the possibility for a strong rebound, I think it very much exists once this panic subsides. But in the meantime, I'll continue to de-risk as necessary. Now, if you're getting some value from this, we're going to do the US stocks in a sec, but if you're getting some value from this, please click that like button and leave a short comment and tell me what you think. Do you think this is going to completely come apart at the seams, or are we close to a big rebound? What do you think's going on? Let me know in the comments and click that like button. It really helps me heaps when you do that, because YouTube shows other people my work. So click that like button now whilst you're thinking of it. Okay, over to the US, and we'll start with the S&P 500. So last week I spoke about how the S&P 500 appeared to be losing its footing, and the reason for that was this developing series of lower lows that have been in place since the January high. Prices closed near their lows. So this is last Friday. You can see where the cursor is. Prices closed near their lows last Friday, which put the S&P 500 in a highly vulnerable position going into the weekend. There was an attempt for prices to rally on Monday and then Tuesday, but again, the rally was sold, taking prices back to their lows by Wednesday, and this set up a vulnerable situation. This is a sort of situation when you get prices closing near their lows. Let me just expand that a bit. When you get these prices closing near their lows, it sets up a vulnerable situation that can lead to fast declines. And it's particularly so when fear is high, as it is now. And so this is when selling can completely overwhelm buyers and prices drop suddenly. Now, this is where it gets fascinating. Look at Thursday. This is Thursday's price action, the last bar on this chart, because, of course, we're filming this on Friday afternoon in Sydney at around 1:15. So this is Thursday's price action in the US and the S&P 500. Now, look at this price action. So the S&P 500, so we had those key lows. Look where the open is. It gapped lower on Thursday. From there, it briefly traded lower before rallying and closing up in the upper half of the range. I'll put this on a 5-minute chart. You can see this a little bit clearer. So that's, of course, a daily chart. Let's go over to a 5-minute. So here's the price action here. There's the gap lower at the open. This price is opened, quickly traded down to their low for the day. Prices then rallied, had a strong rally, sideways trading for much of the day. And when prices were unable to extend lower, there was a strong rally. We got this strong rally into the close. So coming back to the daily chart, now we've seen that in more detail. Coming back to the daily chart, so what does that mean? What does this price action from Thursday mean? Well, it doesn't change the fact that this is still a fragile situation and risk remains high. So we still have that series of lower lows and price remains below these moving averages, which continue to roll over. So all that risk does remain. But it highlights that this is not a one-way bet for the bears. When the S&P 500 was at possibly its most vulnerable point for the year, gapping down below two key lows, rather than fall away, it rallied. So let's just step through that price action because it's important. So when a market gaps below key lows, it often sets off stop loss selling, and then stops tend to draw in more selling, and it's that follow through selling that can then lead to the sharp decline. A good example was in April last year. So we just go back a little bit. Here's April last year. So here are the two key low points. That was in March. So it's two key lows from March. There's our closing price, and then prices gapped lower, broke below these previous lows, set off stop losses. More selling came in, and then much follow through selling came through over the next couple of days. That's what can happen when the market's in a vulnerable position. But that's not what occurred. That's not what occurred on Thursday. What we saw on Thursday is different. It doesn't remove the risk from the situation, but when a market doesn't sell off when it seems like it should, it's worth paying attention to. Coming over to the Nasdaq. And with the Nasdaq, something similar happened in the Nasdaq on Thursday as well. Let's just expand that a little bit. So prices gap lower at the open. There's our first trade. You can see the opening tick there. Prices gap lower at the open. In doing so, they broke to the downside from a 6-week trading range. You can see the trading range, which prices have been stuck in, which we've been discussing quite a bit in recent weeks. And from there, it was, again, it didn't lead to additional selling. Prices, it didn't get that follow through selling. Instead, prices turned and they rallied towards into the closing up not too far from the high for the day. I think the next couple of days are critical for the Nasdaq. Prices are currently sitting right at the lower end. You can see the lower end of this range. They're currently right at the lower end of that recent range. If they sell off again from here, if they were to sell off on Friday or Monday and break below this low from Thursday, then maybe that triggers a larger sell-off. But instead, if they from where they are now, if they rally again back up into the range, well, then maybe we're left with a false break, and false breaks can be key turning points. So this is something to watch carefully in the price action. Coming over to the Magnificent Seven, this is a Magnificent Seven ETF, which tracks those top 7 stocks. This is the most vulnerable of the 3 price structures we've just looked at: the S&P, the Nasdaq, and the Mag 7. It also has the most bearish of the structures. We've discussed in previous weeks for a few of the last weeks. We've discussed this series of lower lows that we've got in the Mag 7, and we've discussed the consolidation below the declining moving averages. So it's the 50 and the 100-day moving averages, and so none of that's changed. We still have the lower lows. We still have the consolidation beneath the declining moving averages. Like the S&P and the Nasdaq, the Mag 7 broke lower on Thursday as well. You can see this, Thursday's trading bar just on the right of the screen. But what's different here is the rally into the close wasn't as strong, and prices remain below the former range. So you remember the S&P and the Nasdaq had those fairly strong finishes, closing back near their highs. Not such with the Mag 7. It remains below. So it's opened and it's closed below the base of support from this recent consolidation. If we look at this situation in isolation, this is not a stock. This is not a stock that I'd want to own, and if I did, I'd sell it on the basis of Thursday's breakdown. But I don't think it's that clear cut across the board for the reasons we've just discussed in the S&P and the Nasdaq. For me, it remains an ongoing process of reducing risk as stops are triggered, but at the same time holding stocks that haven't given cause to sell them. And at this stage, it's, as I said earlier, it's not a sell everything event. As I said last week, be prepared for volatility, follow your plan, and don't let other people's fear become yours. I think that's the most important thing of all. It's just sticking with your plan and not being overrun by the significant amount of fear which is currently out there. Okay, so we're going to go across to the US small caps now. We've got the local small caps. We've got the commodities, a lot to talk about there. And then, of course, your stocks to go through as well. But that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come in, doesn't cost very much. And we're going to go through a whole lot more interesting things which could help you quite a bit. So think about doing that. Okay, so let's start with the Russell, the US small caps.